Hello, welcome to the first video of stage analysis. In this series, we are going to go very deep into the stage analysis. This video might be a long video, please stay tuned. So, in module 1, Introduction to Stage Analysis, we are going to see what is stage analysis, its importance in the trading and investing. We will see the history, the origin, who has introduced the concept of stage analysis and its methodology, and we will finally go through the benefits of stage analysis, how investors and traders use stage analysis to identify market trends. So let's get started. So, what is stage analysis? So, stage analysis is basically a technical analysis method, which is popularized by Stan Weinstein, as you can see in the picture. So, what basically stage analysis does is it categorizes the life cycle of a stock or a market into stages. Okay, so as you can see the definition, it's a categorization of life cycle of a stock or market into distinct stages. So every stock goes through different phases, okay, or you can say a stages. So Stan uh, made this simplification and put it into various stages. So these stages are nothing but stage 1, stage 2, stage 3, and stage 4, as you can see in this picture. So, as per the stage analysis, what you are supposed to do is it basically helps to identify whether to buy, hold, or sell. So, let's say you are in a stage 1. So, in stage 1, you are not supposed to buy stock because this the stage 1 is the consolidation stage or basing stage. So, stock might take longer time to break out from this stage. So, ideally, what is the time to buy the stock? If you are the investor, then it's the stage 2. And whenever you see the stage 3 is coming, or there is a consolidation happening on the top, and the breakdown of this stage, you should it's an ideal time to exit. Okay, so stage 3 is a cautious stage where you should look for the breakout on upside or downside, and stage 4 is nothing but a down phase or downtrend where you should not hold any stock. Okay, so which are the stages which are recommended to be in the stock or to buy? Stage 2. Okay, and which are the stages where you are not supposed to be in the stock? Stage 1, 4, and stage, okay, yes, stage 1 and 4. So let's go ahead. So what is the purpose of stage analysis? So, the first purpose is to identify the current phase of a stock or the market. So, whenever you open any chart, you want to know what phase the stock is going on. Okay, so you want to identify the phase, whether it is in the stage 1, whether it is in the stage 2, or 3, or 4. Second, this thing is to align your investment decisions. So, once you identify these stages, you want to identify the uh, uh, like you want to go through your stocks and find out whether you want to be in a stock or not. So you will align your decisions with respect to the trends, and then uh, based on which stage the stock is, you also want to understand the psychology of investors. Let's say the stock is in the phase 2. So in the phase two, people are very optimistic. They want to buy stock. As soon as the stock pulls back, people jump in and they buy in. So these kind of emotions you have to understand based on the stage analysis. And uh, the stage analysis is also helping you to recognize the importance of timing in the trading decisions. So it's not the case that you can buy and sell the stock in any phase. You have to time the market. You have to buy as soon as the breakout happens from the stage one, and you have to sell the stock as soon as it breaks down from the stage three to stage four. So it is very important to time the market. So let's quickly review the purpose of stage analysis: identification of phase, then alignment of your trading decisions or investing decisions, and then understanding the psychology of investors under different market stages, and then finally understanding the importance of timings in the stock market based on the stages. So let's go ahead. So what is the history? So history of stage analysis is Stan Weinstein, as we have seen. He wrote a book called as Secrets for Profiting in Bull and Bear Markets, and this led the popularization of the stage analysis, and it became the practical approach for traders and investors to use this. And then finally, people uh, evaluated the method. They added few things, and over a period of time it got adopted, and there are minor changes from the time to time people made, and they found it effective. Okay, so this is how it got evolved. So 1988, The Secret for Profiting in Bull and Bear Market book was published. And then what was the systematic approach? So what happened here is, just a second. Huh. So here the market was divided into four stages. Okay. So what are these four stages? So stage one, stage two, stage three, and stage four. Okay. So in this, um, Stan proposed using 30-week moving average as main important thing. Okay. So what is important indicator in the stage analysis as per the Stan Weinstein? 30-week moving average. Along with it, the next indicator was used is relative strength. So remember, relative strength here is not relative strength index, that is RSI. This RS, relative strength, indicate how the stock or the script is performing with respect to overall market. So it's a comparative analysis. Next, we have uh, volume indicator. So it's not shown here. So initially, like three indicators were used: moving average, RS, and volume indicators. So, and this method was primarily focused on long-term investors and swing traders. Okay, so let's go ahead. So, what are the other factors which contributed in this method? So, these you can see, you can call it as influences from other analysts. Okay, so Richard Bekoff, he was a early technical analyst, and he focused on accumulation and distribution phases in the market. Okay. uh, so like accumulation phase, you can relate to stage one, that is a consolidation or basing stage, and distribution phase you can also uh, call it as stage 3. So the concepts like large institutional investors, where big players are buying in stage uh, 1, and then as soon as there is interest from the other people, there is a breakout happening. So all these things, and focus on volume analysis to confirm whether it is indeed in stage 2 or 3. These things were added into the concept later on. And similarly, Charles Dow introduced the concept of primary trends, that is uptrend, downtrend, higher highs, higher lows. And every uptrend, downtrend has their sub phases. Like uptrend might have inside a minor uptrend, downtrend. So all these contributed, and now we have a clear idea of how we can apply the stage analysis. So our setup is influenced by all these giants and technical analysts who have worked over a period of a good amount. Next, we have canceling method, which is popularized by William J. O'Neill. He emphasized more about relative strength and earning momentum. Okay, so here uh, the canceling method focuses on earnings momentum. If the earnings of the companies are good, like 20 plus percent is the growth in every quarter to quarter, then it is considered as a very strong stock. And William O'Neill mm, found in the research or his studies that the multi-bagger stocks, which gives a huge potential gain in the future, are those who have sound earnings, sales momentum. Okay, so we can also incorporate these methods into stage analysis, that is putting fundamentals, earnings, sales, growth, all these things, EPS, all these things into stage analysis. So once you apply all these things together, it becomes a very soundproof technique for the investors. Then there are modern tools like trading views, stock charts. They have made it possible to visualize these concepts very effectively. And there are a lot of screeners which allows you to automate these identification of stocks in various stages. So now you have a simplified approach where you can use alerts or screeners to identify these stages and to confirm and take your decisions. So you are not only uh, going to use these three indicators, that is moving average and volume and RS. You are free to use other indicators with stage analysis. So like people now use RSI, which is a momentum indicator. Okay, MACD, which is also works very fine in the long candles, like weekly chart and daily chart also it works fine. So you can also use these indicators and Along with this, you can use volatility indicators like Bollinger Bands and Keltner channels for understanding what is the volatility, whether there is a compression, whether there is a expansion in the volatility. So you're free to use these indicators, but remember one thing: adding as many as indicators will not give you an edge. Your setup should be a simplified, and every indicator should give one of the aspect of information, like the trend, the volume, the momentum, and the volatility. Okay, these are the four things. So these indicators are a good setup for the Stan Weinstein's uh, setup kind of. So what is the influence of behavioral finance? What is behavioral finance? How people behave? What are their sentiments? So Stan's Weinstein's principles have uh, actually put a light on the behavior of insights. Like stance analysis or stage analysis reflects the fear, greed, these kind of psychologies. So like in stage one, there is no optimism. People have already given up. Nobody's paying attention. In stage two, people are very optimistic. Like stage four, people are very fearful. In stage two and three, people are greedy. So these behavioral things are also considered very nicely in the stage analysis. So if you follow the stage analysis, you are also trying to capture the behavior of people, how they are thinking, what is the mentality, how people are taking decisions in the stock market. So let's go ahead. So when you use stage analysis, you are uh, focusing on the risk management. Okay, so as soon as you are in the stage 3 and there is a kind of consolidation happening on the top, so what you can do is you can put a stop loss. Okay, so as soon as the stage 4 is confirmed, you are out of the stock. Okay, and uh, in stage also, if you are uh, kind of a big investor, you want to accumulate a lot of things, still you can start accumulating in stage 1, and you can place appropriate stop loss. And if the stage 1 is not confirmed and the downtrend again starts, then you can just exit. So this stage analysis also gives you a focused approach on risk management, how you can manage your risks. So now, how people have been using the stage analysis. So you can also go from uh, a daily chart to weekly chart, or you, if you want for a very very long term, then you can have a multi time frame approach. So what was the original focus? Original focus is the long term trends. Okay, weekly chart. But what you can do is you can have a four layouts in a screen where your first chart is on the daily chart, then weekly chart, monthly chart, and quarterly chart. So if you do multi time frame analysis, it is very uh, easier to find out and align the trends. So if the trend on the higher side is uptrend, then on the lower side you will wait uh, for the downtrend to over and you will ride the uptrends only. Or like if the stock is in the long term downtrend, then you will wait for the pullbacks and you will sell the stock as soon as it comes up in the lower time frame. So this adaptation can be done. You can adopt the stage analysis to even the intraday trading or the high frequency trading based on the multi time frame analysis in the stage analysis. Okay, so what are the benefits of stage analysis? So obviously the first one is clarity and simplicity. So you're breaking down the complex market into four stages, and these stages helps you to identify very clearly the sentiments of the market, and you are very clear what you are supposed to do now. Can you use it for stocks and other things, indices, ETFs? Yes, definitely. You can use stage analysis in other assets also. And stage analysis is basically a trend following technique. Okay. So when you are in the stage two, it's riding the trend. And as it is said in the market, you have to be on the right side of the market. So be with the trend. So trend is positive, ride the trend. Trend is negative, exit the market. Okay. You are able to, the stage analysis is also able to help you to manage the risk. So there is no emotional uh, difficulty in deciding whether to buy or exit. As soon as the stage one breakout happens, you are going into the stage, into the trade. As soon as you see there is a topping signs and stage four begins, uh, you exit from the stage three only. So basically, you put trailing stop losses. So if it's going up, you are in the stock, in the trade. As soon as it goes down in the stage four, you are out of it. And based on this, you are able to maximize your profit. Okay, so these are the five benefits of stage analysis. So what? So let's uh, summarize the key points. So stage analysis divides market movements into four stages: stage 1, stage 2, stage 3, and stage 4. Stage 1 is nothing but basing, accumulation phase. Stage 2 is nothing but a riding stage where people are buying and it's an uptrend. Stage 3 is nothing but your consolidation on the top, and stage 4 is downtrend. And the method is based on the Stan Weinstein. It focuses on trend and investors psychology. It offers clarity, reduces risks, and helps you to maximize the profits. So now let's go through some of the questions to check your understanding. So the first question is uh, true or false. Stage analysis divides the market cycles into three distinct phases. So is it three? False. There are four stages: accumulation, advancing, and distribution, then declining. So, next question is, what is the primary purpose of stage analysis? So, option one is predict exact price of stock, identify where stock is in the its market cycle, eliminate risk from trading, or determine dividend yield. So, what is the correct answer? So the correct answer is identifying where the stock is in its market cycle. Next, stage analysis is the dot analysis method used to classify market movements into distinct phases. So what type of stage analysis is? So stage analysis is obviously a technical methods. We are going to only use the chart and historical data for stage analysis. We are not going to use fundamental, though you can use fundamental techniques also along with the stage analysis to increase your odds. Next question. A trader wants to avoid investing in a stock that is declining and instead focuses on trading opportunities. How does stage analysis helps to achieve this? Stage analysis will identify the market phases and trader can focus on stage 2 and they can avoid the downtrend. Next, stage analysis was introduced by Charles Dow. False. It's introduced by Stan Weinstein in 1988. Who is credited for formalizing stage analysis? Obviously, C. Stan Weinstein. The concept of market stages was popularized in which book? So the book is Secrets for Profiting in Bull and Bear Markets. True or false? Stage analysis is only applicable to stocks. False. It can be applicable for all types of assets in the market because all the assets go under the stages, that is fear, greed, optimism. So the stage analysis is applicable in all the assets. So which one of the following is the benefit of stage analysis? Reduces emotional decision making, guarantees profits in trading, eliminates the need for risk management, or predicts future market tops. So it's A, reduces emotional decision making because you have a clear signal. By categorizing market movements into stages, stage analysis provides on what, which, on when to buy, hold, or sell an asset. It provides clarity. Okay, so by categorizing into stages, the movement of stock provides clarity. So now, what is clarity? So you have to match now here. Clarity, trend following, and risk management. So first option is aligns investment decisions with prevailing trends, breaks down market movements into understandable phases, and reduces losses by identifying stage transitions. So it is obviously clarity is B, breaks down the market, so it is understandable. Trend following is A. So when you follow the trend, you can align the decisions, and risk management is C, reduces the losses. Okay, so now investor is struggling to decide whether to hold or sell a stock. How can stage analysis assist? Find out the stage, and if it is in the declining, sell. If it is advancing, hold. So the four market stages reflects the psychological behavior of investors. True or false? Yes, it is. Yes, indeed, they reflect the psychological behavior of investors. Stage analysis integrates price movement, volume, and to identify the market stages. What is the third indicator? It is relative strength. Price movement is your moving average, that is trend. Volume we use to indeed check whether the breakouts are happening on high volumes or not. And the third important thing is relative strength, whether the stock is performing, outperforming than the general market. So match the following. Stan Weinstein, author who popularized the stage analysis, four market stages, framework for dividing market phases, market behavior into phases, and technical analysis, a study of past prices, price and volume data to predict future trends. Yes, it is indeed Stan Weinstein. B, four market stages. A, technical analysis. See, let's go through the next question. The stock has been trending downward for several months but begins consolidating in a narrow range with low volume. If stock is going in downtrend and then for several months it is consolidating in narrow range with low volume. So there are no uh, many sellers, no many buyers. So it's a consolidation after a long downtrend. So what is the behavior in terms of stage analysis? Yes, it is obviously a stage one. Okay, so likely to be the stock in the stage one, signaling the end of downtrend and potentially transition to stage two. If the consolidation breaks upward, then the stage two can be confirmed. Okay, guys, that's it for this video. In the next video, we'll go into this concept again. Stay tuned. Thank you.